Okay, I'm introducing you to Brockhaus Technologies. We've gone through bike leasing, the first subsidiary, and the high level stuff of the business and why I think it's pretty attractive. But let's jump into the second subsidiary now, which is IHSE. So 100% of IHSE was bought in 2019. They paid €135 million for that 100% stake. Now, the CEO stayed on, that's Dr. Enno Littman, and he's still there today. Now, after a little tuck-in acquisition back in a business called KVM Tech, that was back in, I think, 2022, early days of that, they kind of had to go through a pretty tough COVID period. So IHSE provide cybersecurity hardware and systems in mission-critical places. So their products are used, for example, in air traffic control, medicine, the utility sector, transportation, banking, maritime shipping, the semiconductor production, and in the face of some geopolitical challenges lately, also to a more increasing extent in the areas of security and defense. Essentially, wherever latency and system failures or cyber attacks could have serious consequences and people's lives depend on the transmission of data, that's what this business is trying to protect, and they're doing a great job of it. They look after Netflix, for example, Heathrow Airport, ExxonMobil. They're some of the big name clients that they have. Now, unfortunately, margins have been squeezed from COVID and the supply chain issues around microchips. Since they deal with a lot of airports and air traffic control systems, that's why COVID affected them so much. So EBITDA margins are now back to 27% and they're improving. 35% margins was what it was pre-COVID. They've just reported €11 million in EBITDA. And this business hasn't performed like bike leasing with huge amounts of growth. It appeared a great acquisition back in 2019, but as that air traffic control area, that was a major market for them, the business obviously suffered. It's now getting back to those strong levels and winning major contracts. The next few years look pretty positive with expected 10 to 15% per annum growth rates and getting back to that 35% EBITDA margin. Essentially, IHSE is probably back to around the same value as it was in 2019 when they bought the business. And in the meantime, it has returned in that period of time about 40 million EBITDA. So not a great return because of COVID, but still a good business that I think is back on its feet and it has a long runway ahead. I think the returns are now going to start looking good, unless we get another COVID or something like that. Okay, I've talked about the two subsidiaries. Let's now move on to capital allocation, which is obviously very important when you're looking at a management team, what their capital allocation process thinking is like. So this question was posed to the COO. The question was, what are you going to do with the strong cash flow you earn on the back of your strong operating performance? So the CEO, Dr. Marcel Wilhelm, said this: we always select investments with a view to maximizing the increase in value for our shareholders. Okay, that's good. As the purchase prices for potential acquisition targets to strengthen our group have remained unfortunately very high, that's recently, in spite of the sometimes difficult general conditions in the world, we haven't undertaken any active moves in this regard. So essentially what's happened is the expectations and the valuations of middle market tech companies in Germany, their expectations are high, even though the results aren't amazing because of the macroeconomic stuff that's going on. So there's a bit of a discrepancy there. They haven't been able to buy anything because it hasn't met their numbers that they're looking for. He said this: so despite the fact that we looked at numerous interesting candidates that would have basically met our demanding criteria of the average annual revenue growth of more than 20% and EBITDA margins of at least 30%, they're just not prepared to pay any price, and they're not going to change that approach. I like this disciplined approach. It's unfortunate that they can't deploy more money, but I think it's better to hold off and wait for the opportunity to come than deploy money into something that doesn't quite fit what they're looking for or turns into a bad investment. It's better to be disciplined than aggressive, I think, even though I would like them to deploy the money, if that makes sense. Okay, he went on to say this. Accordingly, we've invested the proceeds from the very successful sale of the subsidiary Palace at the end of 2022, and the cash flows for 2023 have gone primarily into repaying debt. However, we also spent around €20 million on bike leasing on acquiring 4 external sales agencies, so those are like tuck-in acquisitions, thereby appreciably increasing the added value of our subsidiaries that our subsidiaries create. That already had a positive impact on earnings in 2023. Then the next question was, and you've bought back your own shares for the first time, why do you see Brockhaus Technologies share as an attractive investment? This is the CEO speaking now, and he jumped in to say this. This is Marco Brockhaus. We do indeed see our share as an interesting investment, and we bought back around 500,000 shares, which is about 4.6% of the share capital, for around €11 million in December 23. And we don't rule out buying back more shares in 24. Our analysts are not the only ones who see plenty of upside potential for their price. You won't find many listed companies in Germany that consistently generate dynamic growth and EBITDA of 35% plus year after year. And as a group, we ourselves more than meet our own 20-30 rules. That's 20% growth, 30% EBITDA margins. They meet that by a long stretch. So we have a very sound balance sheet. We generate a lot of cash flow, and our business model offers the opportunity to invest in innovation and technology champions in the German Mittelstand. Sorry, keep messing that word up. Anyway, we've just talked about our ambitions for 24 and 25, and we'll continue on our growth path and keep on doing all we can to deliver what we promise. Now, turning to their return on invested capital metrics of the two subsidiaries. Well, for IHSE, it's only about 5% return on invested capital per annum. But that was COVID interfered, so I think that will look far better in a few years' time. Bike leasing so far is at about a 15% return on invested capital number thus far, but that's rapidly increasing as that business grows. I think after another 3 or 4 years, that's going to be 30-40% plus return on invested capital and continue to grow because it's growing quickly. So this is their medium-term outlook, so just looking to 2025. So in 2023, they've just reported 187 mil in revenue on 67 in EBITDA, and they're looking at 2024, so in this year currently, to be somewhere between 220, 240, and about 80 to 90 in EBITDA. And then they're looking at 2025 to be somewhere in this range on the right-hand side of the screen, 290 to 320 on 40% EBITDA margins. So doing well over 100 million in EBITDA, that turns into the cash conversion rate's actually pretty strong. But remember, they own 52% of bike leasing. So doing the calcs on this, which is I'm about to get to, is a little bit complicated. Let me try to explain in a moment. But just remember that this does not include any future acquisitions. This is just the two subsidiaries they have currently. So we're not factoring that in. And I think that's a big misjudgment for serial acquirers if you do not allow for future acquisitions as part of the investment thesis. You can miss out essentially on these amazing companies that are able to deploy money. I guess the knock on Brockhaus Technologies so far is they haven't been able to deploy that money consistently yet. So anyway, back to valuation. Marco Brockhaus, the CEO, he had this to say about valuation. In addition to further company acquisitions, we also see our own share as a lucrative investment opportunity with great upside potential. Since Brockhaus Technologies not only meets but exceeds our own ambitious growth criteria of 20% revenue growth, and 30% EBITDA margins. Our voluntary public share buyback program, which was successfully completed in December at €22 per share for the 500,000 shares. We spent €11 million on that, and this should be seen in context. We also reserve the right to acquire further shares of Brockhaus Technologies within the scope authorized by the annual general meeting. Okay, now this is where it gets interesting. He said, the potential of our share is demonstrated by the assessment of one of our equity research analysts, who attests that the price could rise up to €68 currently. That is a huge discrepancy compared to our current valuation on the stock market. We have to do something about this, and we are therefore looking at all options intensively and above all with an open mind. And for those watching in the future, the stock price when I'm recording this is €22 a share, and I'm recording this in April 2024. So here's some of my valuation work for Brockhaus Technologies, and I've just put the current revenue in that they reported in 2023, and I'm growing that out at 15%. Now, they're actually targeting to grow at about 25% per annum for the next 2 years. I'm just wanting to be a little conservative, saying that I don't know the future, so I'm trying to slow that down a little bit just to be a little bit on the conservative side. I can play around with this later, but I'm just putting it here for the moment. And the next thing I needed to talk about was the estimated free cash flow margins. So this includes the 52% ownership of bike leasing, taking that into account, which means there's 48% of bike leasing that we don't own as shareholders. So why I think at the moment in 2023, the Brockhaus Technologies free cash flow margin attributed to them is actually only at about 10%. And I'm actually going to say that this expands out to 18%. So why do I think the margin will expand? Well, the reason is because bike leasing is in a land grab mode at the moment. They're trying to get as many corporate customers on board as they can against JobRad, who is their main rival in the space of bike leasing. Essentially, all the resources are going into just flat out growth mode it's a land grab essentially of what's happening here. Because once they get these clients onboarded and their employees have leasing agreements through bike leasing, then that's going to be very sticky and they can upsell them other things into the future. But right now, the margins are a bit slimmer than they should be because they have to go be aggressive. They're actually still making really great money and really great margins, as you can see with Brockhaus Technologies still having great revenue. I think this is actually only going to increase in terms of free cash flow, like what falls down to the bottom line for them. Hence why I think this is going to improve. So essentially what I'm saying is the bike leasing expansion it'll wind down at some point in the future. It won't be as aggressive as they're taking it now. Therefore, margins will expand, in my opinion. I also think that IHSE is going to continue their margins. They're increasing their margins each year for the last couple of years. I think that trend is going to continue upwards as well, pushing free cash flow margins for Brockhaus even higher as well. Now, I also think margins will expand because since Brockhaus Technology is, as you can see with the market cap being only 240 million, they've got corporate costs, right? There's 10, 11 employees now, I think, at head office. That's going to not grow at the same rate as the business grows, like as bike leasing and IHSE grow. So as the corporate overhead costs stay similar as a percentage of the business, it's going to become less and less as those other businesses grow and grow, if that makes sense. So the margin should also improve because the cost in relationship to the revenue is going to be better. So free cash flow should improve in that way as well. Hence why I think going from 10% to 18% in the next 5 years is very feasible. I could even be conservative on that, but I'm happy with 18%. Okay, I think that explained that as clearly as I could. Then I've got multiple. So the future free cash flow to market cap. And I've looked at some comps here. I've got Halma, Roper, Judges, and Vitek over here on the side. Yes, they're more experienced. Yes, they've got bigger track records in public markets. They're better businesses. But I would argue in 5 years' time, Brockhaus Technologies could warrant at least a 15. That's half of what these companies are. I would say it could be even 20 if they can prove themselves to have growth rates of 20% plus, 25% plus. That multiple could easily be higher. So I'm going to be conservative and say 15 is probably very fair for the business. Probably a little bit on the low side. Okay, now I've got the dilution rate of 1%. Now that's not the case of what's been happening lately as they've been buying back stock. They bought about 4% of the stock outstanding back last year. And so shares outstanding, I'm assuming, is going to grow at 1%. I'm just saying that buybacks are not going to happen anymore. And this is not factoring in the dividend either that they've just announced, a small little dividend. It's only like 0.5% or something, 1%. It's quite small. But I'm getting a 5-year compounding growth rate here with these numbers at around 32%. So that's how I'm doing a valuation of this. Like I said, I think revenue could be growing a lot higher than 15%. I think the multiple could be higher than 50%. I even think margins could be 18%. I think is, it's going to go from 10 to 18%. I think it could even go higher, but let's call it 18%. I'm not factoring in acquisitions here. So yeah, this is my thoughts on valuation. So Chris Mayer's 100 Baggers book is a study on companies that have gone up 100x the original investment. And here are those attributes again. Lots of growth. Cheaper is better. The ability to reinvest high amounts of capital at high rates for a long time. Smaller companies preferred. And they have an owner-operator. Brockhaus, yes, has only 2 subsidiaries. So that's the first knock on them at the moment. They haven't got that acquisition engine flying along like those comparison businesses of Judges and Vitek and Halma and Roper. And the second knock on them is that the reporting is kind of complicated. The financials are hard to follow. There's a lot going on. We have to remember that 52% ownership in bike leasing, then that disposal of Palace and all the tax minimizing shenanigans in the profit and loss. The cash flow statement actually gives me some relief, but they report this free cash flow before tax number, which I find kind of weird. What gives me comfort regarding the kind of that annoying complexity is the large insider ownership. So Marco owns the largest holding in the business, and most of the management, I think all of the senior management anyway, have decent stakes in the company as well, as a shareholder just like me. Marco's remuneration package also isn't excessive, so he's not just using this as a cash cow for himself, and the benefits to him personally are going to be the performance of the stock price. And I do believe that they are strong capital allocators. I like that they're buying back their own attractive stock that meets their criteria for acquisitions. They're buying bolt-ons as well for bike leasing. I think they will add more businesses over time. It's good that they're disciplined and waiting for something they like, and this isn't factored into that valuation. Now, I made my investment in Brockhaus Technologies through Interactive Brokers. There's a link in the description for that. It gave me access to the German market, which was perfect for this. I hope you've enjoyed my two-part series on Brockhaus Technologies. I'm going to hopefully, as new information comes out about Brockhaus Technologies, I want to report it here on the channel. This is going to be something that I follow very closely. I feel like I'm going down this path quite alone at the moment. There's not many people to talk to about this. I am very interested in seeing what happens here and seeing whether I have made a good decision here. It always feels a little bit uncomfortable when you make a pretty sizable investment into something and you don't have, smarter, better investors out there that have invested in the company alongside you. And I guess I feel like I'm just going about this one alone. So I'm going to try to keep track of this. It's going to be a great learning experience for me. I'm definitely putting my money on the line here for this one. I think it's my biggest holding. TIKR is pretty close. They're about the same. So yeah, we're gonna just have to see how this goes. This is my big call for the year anyway. It's going to take a few years for this to play out, but if those projections work out like I think they are, if this business continues like I think it will, if they can buy another acquisition, anything like this happens, I think it's just going to be a matter of time before this gets picked up by other people and they see what I see. But I might be missing something, and that's the big fear that I have is what have I not covered? What have I not seen? Is it too complicated for me? Is it something that is outside of my circle of competence? Is it something that, am I missing something? That's going to be my big question. That's something that I'm going to have to follow along. Time will tell. I hope you enjoy following it along with me. Let's see how we go. If you have any questions for me about the company, please ask me. I'm going to try my best to answer them. All right, that's it. Thanks. See you in the next video.